In this video, I'm going to briefly sketch out some of the factors that relate to retirement and how those connect with annuities. And a couple of the factors that kind of link retirement planning with annuities basically start off with the idea of the retirement life expectancy. So this is different from regular life expectancy. Regular life expectancy is just kind of how long a person is expected to live. Retirement life expectancy takes how long that person is expected to live, but then subtracts off when they retire, and you're finding the gap. So basically, how long the person is expecting to live while retired. And so that's kind of the idea behind the retirement life expectancy. Well, with life expectancies generally rising, the retirement age hasn't necessarily risen as much as the life expectancy has. And so as the life expectancy kind of continues to get larger, then with retirement age, if it stays relatively similar, then there's a longer period in retirement. And if there's a longer period in retirement, that can strain a person's resources, the financial resources they have during that retirement period. Now, something that significantly impacts that is the impact of inflation. So inflation is when things cost more broadly over time. So it's not just one item, but if everything you buy at the grocery store, like the whole basket or whole shopping cart of things you typically buy, a gallon of milk, eggs, orange juice, cereal, meat, if everything is going up, and not just groceries, but also housing costs, car insurance costs, fuel costs, if everything that you're buying is going up generally as a group, then that's the idea of inflation. Now, importantly, even if inflation is low, say 1 or 2% or something like that, over an extended period of time, such as during retirement, it can accumulate to be quite significant. So a person might not really feel the impact of, say, 2 or 3% inflation over 1 year, but if you include that over, say, 20 years, over 20 years, that actually significantly erodes the purchasing power. So you may not, if you had just inflation of 2%, you may not really feel the difference as much with what $1,000 could buy now compared to what it buys in a year. But if we have 2% every single year for 20 years, such as from when you're 65 to when you're 85 in retirement, well, that starts to really be a meaningful have a meaningful impact upon what you can actually buy. And so if you were kind of planning to withdraw a set amount of money, what you're actually going to be able to buy with it is getting smaller and smaller and smaller. And so that could mean you don't have as many financial resources as you thought you did in terms of what they can actually provide for you. And that brings us to the topic of superannuation. And the idea of superannuation is basically that you outlive your resources. And so you live longer than what you have financial resources for, which is obviously a bad thing. So basically, between people having a longer period of time that they're going to be in retirement and the cumulative effect of inflation, it's quite possible for people to outlive their financial resources. And as we're going to see in subsequent videos, this is where sometimes annuities can help in some respects, where maybe they can provide some additional sources of income. In some cases, that might kick in later years to kind of help offset some of those concerns. Hopefully this video has been helpful. Thank you for watching and have a great day.